We know some basics of income statement items. We want to build upon what we know and get a little more in depth and a little more detailed for some other things that we might see on an income statement. The first thing we want to look at are the different formats that we find the income statement. Now, we've talked about, at least you should be familiar with the first two. Okay? Single step is where we have all of the revenues listed first, all the expenses listed next, and then we take the difference. We total up the revenues, total up the expenses. The difference is our net income or loss. Okay, that was kind of our first basic. Then we got a little bit more detailed, the multi-step. So this is where we split out and had all of your sales data first, your sales revenue and any contra revenues that we had. We got net sales. Then we had your cost of goods sold. We got gross profit. We listed out all those operating expenses, usually in the categories of selling and administrative expenses. We got income from operations, and then we had those other categories at the bottom. So we had all the operating there for income from operations, then we had other income or other revenue and other expenses as well, and then we had net income. So the multi-step gave us a lot more detail. Now there's one other one that we haven't talked about too much, and it's called the condensed version or the condensed format. It still has the same ordering as a multi-step, but it's only a single line item. So instead of saying under the operating expenses, selling expenses, and you have 20 of them listed there, you would have just one line for operating expenses. It would have everything. Or you might have a line for selling expenses and a line for administrative expenses, but it would be the total of those. It would not be the 20 item list. And then you could provide supplementary details and information to show what that is made up of. But a condensed is kind of exactly as it says. It's a condensed way, an easier way to look at those details, that your statement isn't as long and isn't as convoluted sometimes to the users. But it's the same ordering as a multi-step, not a single step. Okay, so that's the condensed version. Now let's talk about some items we haven't seen yet on an income statement. So your income statement is, again, we go all the way down to income from operations. We have those other categories. So we've gotten the operating section and what we call the non-operating section, which are the other categories. Those we're familiar with. Now, after we get the others, if we're going to take into account tax, then we have our tax rate, and a lot of times you'll see EBIT, or earnings before income and taxes, or interest and taxes, and might see those separately. Or sometimes you'll just see income before income tax, or earnings before income tax. Then you would apply your tax rate, calculate how much tax that you're estimating that you're going to be paying, subtract it, and get the bottom line of net income. Okay, so all that we should have seen before. But now we're going to put some things that we haven't seen. The first one is unusual gains and losses. And these are items that would be somewhere in those sections we've talked about, usually in the other section, either other revenue or other expenses, depending on whether it's a gain or a loss. It's usually how you're going to find this. These are material items, but they're either unusual or infrequent, but they're not both. So this would be something that maybe you have to write down your inventory. And so it would be either unusual or infrequent. Kind of have to, if it falls into one of those categories, we consider it an unusual gain or loss. If you sold some assets that you used in business, that might be an example where it's an unusual gain or unusual loss. So those are going to be up above the calculation for income tax. So they're going to be in that other category somewhere. Now, the rest of these, however, are items that would come after our income tax calculation. So these will be below that line. The first one, we've got discontinued operations. So if you had a product line, say, that wasn't really profitable, or you just didn't like it, or for whatever reason you've decided it's not in the company's best interest to continue that. So you're going to discontinue it. You're going to stop production, you're going to get rid of things, maybe sell off all the equipment for that line, everything. It's gone. That's a discontinued operation. It's when you have some kind of component of your business and you can separate out those operations and distinguish it from the rest of your company and actually show that you've gotten rid of it. It has been discontinued. We're going to show that discontinued amount as a separate line item below income tax, and we're going to calculate tax on it and show it net of tax. Anything below that income tax on the income statement, you have to calculate the tax and take into account the tax effect for that, because you're listing it below it. Everything above, we've calculated tax on, so everything below also has to have the tax already accounted for each item. So discontinued operations would have an item that says net of tax. Extraordinary item, or extraordinary, however you like to say it. This is something that sounds like an unusual gain or loss, and it does kind of remind you of that, but here's one thing that's very important that's different. It's got to be both of the characteristics. Where unusual was one of them, now this has to be both unusual and infrequent. So it's got to be something that's not normal. It also has to not occur frequently. Okay, so not a recurring item. So an extraordinary item. Casualty losses might be one, or you could have a gain, I suppose, as well. But that would be maybe one example, or maybe a natural disaster, something like that. Although there are some issues with natural disasters. If you lived in, say, a floodplain and you got a extreme flood, might not classify it as an extraordinary item. Again, you got to consider, is it unusual and infrequent? So those are the two things that you have to consider. Again, this is going to be below the income tax line, so this is going to be net of tax as well, net of any tax effect. Go ahead and either add or subtract depending on what the tax effect is. Put it below. Non-controlling interest. Okay, this is where you have a company and they're the parent company and there's a subsidiary, so they own equity in another company, but let's say that they're not 100% owner. So they own, say 60% of the other company. Well, somebody else owns 40%. Maybe several people make up that other 40%. So you need to show how much of that interest is your controlling and how much is non-controlling. And we're relating that specifically to your net income figure. So when you get net income with subsidiaries, remember you're going to have to consolidate that. So you'll have a consolidated net income between the parent and the subsidiary company. But I just want to show that that's all of it combined. But I want to show just my controlling interest. So 60% of that would be mine. The 40% is someone else's. So you want to take into account how much of that net income is actually someone else's ownership. And you subtract it out to show how much you actually have as a controlling interest. And usually you're going to see that reported as a separate line item, and it's going to be actually below net income or loss. When you finally get down to the bottom after you've taken into those new things we talked about, discontinued operations, extraordinary item, that are net of tax, get net income, and then if you have something like this, you'll see that controlling and non-controlling interest as a little detail or a separate line item listed out below net income. And one other item, which we're probably familiar with, but we want to bring it back up, is earnings per share. And this is a pretty straightforward calculation. It's not very difficult. Just a few things to watch for that I'll make note of. And this is a measure that is very widely used for accounting and finance, and something that's looked at by investors often, earnings per share. And this would be something that would be stated on your income statement usually. If not, it would definitely be in the footnotes. But a lot of times under net income, you'll also see earnings per share. So here's the calculation for earnings per share. I didn't put the formula on here, but I'll tell it to you, and it's in your text as well. But you're going to take net income and subtract out any preferred dividends, and then you're just going to divide that by your weighted average of common shares outstanding, and that gives you earnings per share. So we're talking about common when we talk about earnings per share. Now, I said there were a couple things to make sure you were aware of. Okay, just a few little things. The first one, when we say net income, we're only talking about net income for the controlling interest. So we just talked about non-controlling and controlling. interest, so that net income attributable to the controlling interest, that's the one we want. Okay, so that's what we're talking about for net income. Our shareholders wouldn't be entitled to anything that was part of the non-controlling interest, so we don't want to include it. And then when we talk about preferred dividends, we're talking about these are dividends declared, or if it's cumulative, even if they're not declared, we would want to calculate them here because it is cumulative. So those are just a few little things to look at when you talk about earnings per share. But all of these extend out and give more detail and more depth to the income statement so that we can have better analysis and understanding of the details on that.